Welcome to the Time and Market Deep Dive. Just a quick reminder before we talk numbers, this show is strictly for entertainment purposes. We are not financial advisors, so please seek professional advice before making any major moves.
Yeah, absolutely. Always good to get that out the way first.
Right, exactly. So today is Wednesday, June 24, 2026. And I mean, if you are an income investor building a portfolio for the long haul, you already have this date, like circled, highlighted, and underlined in red ink.
Oh, for sure. It's a massive day.
It really is. Today is the exact ex-dividend date for the Schwab U.S. Dividend Equity ETF.
Better known by its ticker, SCHD. And honestly, what we're looking at today is completely unprecedented for a fund of this nature.
Yeah, so today we're basically giving you a masterclass in how this supposedly, boring dividend fund turned into one of the hottest, most talked about wealth-building vehicles on Wall Street this year.
It really has been the talk of the town lately.
It has. And, I keep thinking about SCHD like that hyper-reliable, strictly disciplined friend of yours.
Right, the one who always goes to bed at 10 p.m.
Exactly. Never skips leg day, strictly budgets their groceries down to the penny. But then, out of nowhere, they show up to the dinner party in a bright red sports car.
That's a perfect analogy.
Right, because dividend funds are supposed to be sleepy, slow-moving value plays. So how is a fund designed around absolute financial conservatism suddenly crushing it in 2026?
Well, the answer to how they bought the sports car is fundamentally linked to that strict 10 p.m. bedtime.
Okay, unpack that for us.
So when the broader market gets chaotic and highly volatile, an index that is just utterly ruthless about financial quality turns that conservatism into a massive performance engine.
Ah, I see.
Yeah, the rest of the market is experiencing whiplash, but this fund is just built to absorb shock.
Okay, well, before we pop the hood on this recent performance boom, we really need to establish what that unshakable foundation actually looks like.
Let's do it.
I'll play the data provider here to lay out the core stats because, you have to understand the rule book to understand the returns.
Very true.
So SCHD tracks the Dow Jones U.S. Dividend 100 Index. It has an ultra-low 0.06% expense ratio, and it boasts this legendary 14-year consecutive streak of increasing its annual dividend payouts.
Okay, wait, let's stop right there and look at that expense ratio, because 0.06% is practically free.
It's basically nothing.
Exactly. When you compare that to actively managed income funds that charge, 0.75% or even 1%, the compounding math over 20 years is staggering. You are keeping almost all of the cash generated by the underlying businesses.
Wow. Yeah, that makes a huge difference.
And that 14-year track record of increasing payouts, that isn't some happy accident managed by a brilliant stock picker.
Right, it's not just luck.
No, it is hard-coded into the index's DNA. The most ruthless rule of the fund is that a company must have 10 consecutive years of dividend payments to even be considered for inclusion.
10 years. I look at that 10-year rule, and I think of it like the bouncer at an incredibly exclusive club.
Yeah, a very strict bouncer.
Right. This bouncer does not care who you used to be. You could be a massive, multi-billion-dollar legacy company, but if you had one bad quarter during a global crisis 5 years ago and responsibly paused your dividend to preserve cash...
The bouncer turns you away?
Yep. Wait, so if they pause it just once, they're permanently banned from this ETF for a full decade? No exception.
No exceptions, no turnaround stories, no nothing. You are out.
That feels almost blindly rigid.
It is rigid, but you have to understand why that ruthlessness protects the everyday investor. When you drop that 10-year filter, you open yourself up to dividend traps.
Oh, right, the classic trap.
Yeah. A dividend trap occurs when a company's stock price plummets, which mathematically makes their dividend yield look artificially high.
Well, it looks tempting.
Exactly. But in reality, the underlying business is bleeding cash and a dividend cut is imminent. So by enforcing a strict 10-year backward-looking filter, SCHD completely removes companies that lack the institutional discipline or really just the sheer financial resilience to sustain payouts through multiple brutal economic cycles.
Wow. Okay, and here's another detail buried in the prospectus that directly impacts your wallet when tax season rolls around. SCHD holds exactly 0 real estate investment trusts or REITs.
None at all.
Which is huge, because if you are listening at home and holding assets in a standard taxable brokerage account, this is a massive deal. REITs are legally required to distribute at least 90% of their taxable income to shareholders.
Which means they usually offer very juicy yield.
They do. But the IRS treats REIT payouts as ordinary income.
Which hurts, because if you are a high earner, those REIT dividends could be taxed at your highest marginal tax rate, pushing all the way up to 37%.
Ouch.
Yeah. But by intentionally excluding REITs from its methodology, 100% of the payouts you receive from SCHD are classified as qualified dividends.
And let's translate that tax jargon into real money for a second. Qualified dividends are taxed at the much lower long-term capital gains rates.
Right, which makes a big difference.
Exactly. We're talking 0%, 15%, or 20% depending on your income bracket.
Yeah.
So SCHD is handing you cash, but it's deliberately giving you the most tax-efficient type of cash possible outside of a Roth IRA.
That is a massive structural advantage. And really, that foundation of extreme quality control and tax efficiency is the launch pad for the massive run-up we've seen this year.
Yeah, the performance has been wild.
Let's look at what happens when that strict methodology collides with current market conditions.
Let's do it. We're talking about a fund that is up roughly 14.4% to 16% year-to-date.
Which is incredible.
It is. And if you look at the trailing 52-week recovery from its cycle lows, it has delivered an amazing return of nearly 24%.
Yeah.
The share price has shot up to around $31.70. I mean, for a value-focused dividend ETF, those are growth stock numbers.
They really are. And because the stock price has appreciated so rapidly, we are seeing the classic seesaw math of dividend yields in action.
It's a seesaw math, right?
Yeah, so its current trailing dividend yield has been slightly compressed down to about 3.3%.
Okay, I want to break down that seesaw effect because I think it confuses a lot of new investors who wonder why their yield is shrinking when the fund is supposedly doing great.
It's a common question.
Right, well, dividend yield is just a simple division problem. It's the annual dividend payout divided by the current stock price. So if a company pays $1 a year and the stock costs $20, your yield is 5%.
Simple enough.
But if stock price suddenly shoots up to $30 and the payout is still just $1, your yield drops to 3.3%. The cash didn't shrink, the asset just got more expensive.
Exactly. The denominator grew faster than the numerator. So right now, anyone buying new shares of SCHD is locking in a compressed yield of about 3.3%.
Okay, let me play the skeptic here for a second.
Go for it.
If pure high-yield funds are out there aggressively advertising 5% or even 8% right now, is a compressed 3.3% yield really worth bragging about? Aren't you leaving money on the table by playing it this safe?
Well, you are leaving risk on the table, not necessarily wealth.
Okay, fair point.
If we zoom out and look at total return, we have to look at how this fund behaves during a panic. Let's compare SCHD to another heavyweight, the Vanguard Dividend Appreciation ETF, or VIG. SCHD has a beta of 0.68.
Okay, let's define beta really quick for our listeners. The broader market, like the S&P 500, has a beta of exactly 1.0.
Right?
If the market drops 10%, a stock with a 1.0 beta drops 10%. So the beta of 0.68, SCHD is basically wearing heavy shock absorbers.
Exactly. VIG, by comparison, has a beta of 0.82, but the metric that truly matters to your long-term wealth is the maximum drawdown. Over the last 5 years, SCHD's worst drop was 16.8%.
Wow, okay.
VIG's was 20.4%. When you chase an 8% yield in an unscreened fund, you are almost always buying into massive price volatility.
Yeah, you're buying a roller coaster.
Exactly. SCHD wins the long game by falling less during market chaos. When you lose 20% of your portfolio, you don't just need a 20% gain to get back to even, you need a 25% gain. By capping the downside, SCHD preserves your principal while paying you to wait.
That makes a lot of sense.
Yep.
That structural defense makes the 3.3% yield look much more attractive.
It really does.
So let's take that theoretical yield and connect it directly to the actual cash hitting your account because, as we mentioned, we have brand new numbers.
Yes, we do.
The official Q2 2026 dividend distribution was declared yesterday, June 23rd.
And the official payout is set at $0.2525 per share.
Right. And just a reminder on the calendar mechanics here, today, June 24th, is the ex-dividend date.
Yeah.
That means you had to literally own the stock by yesterday's closing bell to get this specific payout.
Yeah, if you buy it today, you miss the cut for Q2.
Exactly. The official pay date, when the cash actually lands in your brokerage account, is this coming Monday, June 29, 2026.
And, you know, human nature dictates that the first thing investors do is compare that Q2 number to the Q1 number to see if their income went up.
Naturally. And if they do that, they're going to hit the panic button.
Oh, yeah, they will.
Because the Q1 2026 payout was 0.257 cents. This new Q2 payout is 0.2525 cents. That is a slight dip of now 0.00044.
A tiny dip, yeah.
But before we get into the mechanics of that drop, we have to clear the air about the October 2024 stock split. Because there is a terrifying chart circulating online right now that is completely detached from reality.
Oh, I've seen it. Automated financial data sites are notorious for scraping raw historical numbers without applying any corporate action context.
It's so bad. If you look at some of these free dividend trackers, the graph shows SCHD paying over 75 cents a share in mid-2024, and then suddenly the line just plunges down to 25 cents.
Visually, it looks like a disaster.
Right. It looks like the fund suffered a catastrophic 66% dividend cut.
But in reality, October 2024 brought a 3-for-1 stock split. Think of it like taking a pizza and cutting it into more slices. The size of the pizza didn't change at all.
Right.
For every 1 share you owned, you were given 2 additional shares. The share price was divided by 3, and the dividend per share was divided by 3. The total cash hitting your account was completely unaffected.
It was just spread across more shares to make the entry price more accessible.
Exactly.
Okay, so split confusion aside, SCHD's entire reputation is built on 14 years of consecutive growth.
Right.
How do we explain a genuine quarter-over-quarter drop from Q1 to Q2 to a nervous investor who expects the payout to strictly move up and to the right?
Well, we need to look at the actual plumbing of how an ETF collects and distributes cash. Think of the ETF manager holding a giant bucket.
Okay, bucket.
Inside SCHD, there are 100 different companies, each with their own board of directors declaring dividends on completely different schedules. The manager catches this steady rain of cash in the bucket and then pours it out to shareholders 4 times a year.
So because those corporate payout schedules don't perfectly align with the ETF's quarterly distribution dates, the volume of cash in the bucket naturally fluctuates from quarter to quarter.
Precisely. Historically, SCHD's fourth quarter, the December payout, is significantly larger than the rest, as companies issue year-end special dividends or finalize their annual true-ups.
So you really can't just compare Q1 to Q2 in a vacuum.
You can't. You have to look at the trailing 12 months, or better yet, the long-term annualized compounding rate. Over the last 5 years, SCHD's dividend growth rate has averaged between 8.7% and 11.6% annually.
Wow, okay.
So a fraction of a penny dip between consecutive quarters is just the normal mechanical noise of collecting cash from 100 different corporate calendars.
That makes total sense. Now, to really understand how SCHD sustains that 9 to 11% annualized growth while pushing the stock price up 24% over the last year, we have to look under the hood at the March 2026 reconstitution.
Oh yeah, the engine rebuild.
The fund just underwent a massive engine rebuild.
The annual reconstitution is the only time the underlying algorithm really does its heavy lifting. And this year, the turnover was staggering. Nearly 30% of the portfolio was completely swapped out.
30%. We were talking about 25 additions and 22 removals. They dropped massive household names like AbbVie, Cisco, and Valero.
Gone.
And they backed up the truck for heavyweights like United Health Group, Abbott Labs, and Qualcomm. I mean, this algorithmic rebalancing feels totally counterintuitive. It's like a sports team trading away their star MVP right after winning the championship just to draft undervalued rookies. Is this strictly a buy low, sell high mechanism?
Well, it feels counterintuitive because humans are emotional creatures who fall in love with winning stocks, whereas the algorithm is completely emotionless. The index effectively forced the fund to systematically sell strength and buy weakness.
Sell the winners.
Right. Companies like AbbVie and Valero had run up significantly in price. When the price runs up, the yield drops. The algorithm recognized that their yields were no longer competitive relative to the broader market, so it locked in those massive capital gains and discarded them.
And on the flip side, a fundamentally stellar company like United Health had experienced a short-term price dip due to regulatory noise.
Exact.
So the algorithm scooped up temporarily discounted shares of a world-class business. But it isn't just a blind buy low, sell high thing, right? The fund relies on a very specific 4-factor screen to make these decisions.
It does. The 4 factors are cash flow to debt, return on equity, yield, and the 5-year dividend growth rate. And each one serves a very specific defensive purpose.
Let's unpack those because I think this is where the real protection lies.
Sure.
Cash flow to debt is pure survival in a high interest rate environment. I mean, if a company has massive debt coming due and no cash flow to service it, they have to refinance at terrible rates, which destroys profitability.
Spot on. Then you look at return on equity, or ROE. This basically measures management's efficiency. Are they burning piles of cash just to tread water, or are they a well-oiled machine turning every dollar of capital into profit?
Right. And then the third factor is yield, which is just the initial hurdle rate. But the fourth factor, the 5-year dividend growth rate, is really your inflation fighter.
Exactly.
If a company's dividend growth stalls out, the algorithm boots it. We actually saw this with Cisco. Their 5-year growth rate dropped significantly below the sector median, and the algorithm instantly cut them loose.
Yep. Because of that strict four-factor screen, we witnessed an automatic massive sector rotation this year. The index systematically reduced its exposure to energy stocks by about 8%.
Wow. And it rotated heavily into healthcare, adding United Health and Abbott along with consumer staples.
Doing the heavy lifting.
Yeah. The algorithm effectively decided that the current economic environment requires defensive posturing. Institutions are doing the exact same thing right now. They are rotating toward traditional dividend-paying value names rather than just chasing high-flying tech.
By holding consumer staples in healthcare, things people buy regardless of what the economy is doing or what the Federal Reserve decides, the fund builds an absolute fortress around its cash flow.
It's fascinating. So let's bring all these data points together because there is a fundamental debate staring every income investor in the face today.
Let's hear it.
Does the recent stock price run-up make SCHD less attractive to new buyers because of that compressed 3.3% yield? Or does its 14-year consistency, its defensive sector rotation, and lower volatility make it an automatic foundational buy regardless of the price?
Well, it comes down to what you want. Are you looking for the absolute highest yield today, knowing you are taking on the risk of devastating dividend cuts? Or are you looking for an income stream that grows at roughly 10% a year and acts as an anchor for your portfolio during turbulent times?
We want to know where you stand on this. Drop your thoughts and your own portfolio strategies in the comments. Are you backing up the truck for SCHD at $31.70, or are you hunting for higher yield elsewhere?
Yeah, let us know. But before we sign off, there's one final mathematical reality we need to leave you with regarding that October 2024 stock split.
Ah, yes. The DRIP snowball, the dividend reinvestment plan. Because of the 3-for-1 split, the share price is sitting comfortably in the low $30 instead of approaching $100.
And that lower share price makes it incredibly easy for retail investors to automatically reinvest their quarterly dividends into whole shares.
You don't have to wait months to buy a share.
Exactly. You don't have to wait 6 months to accrue enough cash to buy a single share. It happens almost instantly. And historical data shows that DRIP compounding is the ultimate wealth cheat code.
It really is.
Across the long term, reinvesting those dividends can turn a $10,000 initial investment into over $44,000.
Yeah. Well, taking the cash and just spending it only gets you to about $37,000. That is the $7,000 difference just by flipping a switch in your brokerage account and letting the math do the heavy lifting.
It turns out that strictly disciplined friend in the sports car didn't win the lottery. They just let compound interest buy the car for them.
Seriously, it makes you wonder if a completely emotionless algorithm can outperform millions of highly emotional human traders by just ruthlessly sticking to the fundamentals. What other areas of our financial lives are we ruining simply because we can't resist tinkering?
Something to think about.
Definitely something to explore as you review your own portfolio this week. Thanks for joining us. Time in Market beats timing the market.